Good afternoon, folks. This is 17th of June, and today I have a really good one. The first half will probably go out to YouTube, to the English channel, and the second half is not. And in today's live stream, we're going to talk about why the European markets are crashing, why the DXY is going to the upside, and how could the US market react for that. I'm going to clear down all the possible scenarios and possibilities, what is going on the market, and we will a little bit better understand, and also on the second half we're going to know how to react and what to watch on the market. So very valuable live stream. First of all, let's just see what happened last week, and I particularly focusing on one data, and this data is the US CPI, what we received, and also the PPI, so all the inflationary data, what we got. Now, the core CPI, the monthly one, went down from 0.3% to 0.2%. The monthly CPI went down from 0.3% to 0.0%. And the yearly CPI went down from 3.4% to 3.3%. And of course, the federal funds rate remained at 5.5%. So if we take the core PPI and the PPI to this, which both declined, especially the normal monthly CPI from 0.5% to minus 0.2%, that's a 0.7% decline. So that's a huge pushback on the inflation, and this is a negative news for the DXY. So some of us asking why the DXY is going down, what is the reason? Now, that was the first reason, because this data is actually very negative for the DXY. That's why we got that big red candle on that day. And no surprise. So, of course, the market is reacted for the macroeconomic data as it's supposed to be. Now then, this is the second question, which everybody asking, that in the next or the following 2 days, why the DXY went to the upside afterwards. Now, overall, let's just gathering together all the data we have so far in the financial markets. And we know that the ECB didn't raise interest rates. In fact, they cut interest rate with 25 basis points. So due to the ECB rate cut, pushed the EU and the UK market to the downside, and both the euro and the GBP is also down. So these together are really strong enough to push the DXY to the upside after we saw the CPI and the PPI numbers and the decision of the Fed. Now, as you know, we got that negative push on the DXY, but when we got the Fed decision, you see that the market is already started to push to the upside from the zone we have here, which is a very strong zone. And this push up continued on the following days. So there is a couple of facts we need to take a look at, and so you will understand exactly why this aggressive upside movement is there on the DXY, and by the way, why the intraday traders need to pay attention for the rejection we got on the last day. And so we will take a look on that. But first of all, we need to understand why the European market is down. So let me just switch to the chart first of all, because this is very important. And I changed the picture here for the live stream presentation as well to the technical charts. So we see here the DXY, and we see that today it continues to go to the upside. And I just mentioned that the European market is going down. Now, this is an easy peasy lemon squeezy, because if we take a look, DAX is already crashing like hell, breaking the zone to the downside, very aggressive in the last 3 days, including today, already underneath the 50 EMA. And it has no power, or at least until that moment, had no power to retest the cluster which created by the 50 EMA and the scale EMAs on the daily time frame, which suggests that we're probably going a little bit lower, and then we're going to make a retest on the zone itself and not on this cluster point. And that shows us how significantly strong the DAX to the downside. Now, the other one is the FRA 40, which we talked about earlier because there was an European Parliament election. And I mentioned when we've been up here, and folks on the Discord server were asking me that what do I think about the FRA 40 after the European Parliament situation. And I emphasized that I feel like this is a very negative pressure, and this negative pressure might be stronger than any kind of macroeconomic data we get. And that came true, so we immediately started to fall when the market opened, and in a very short period of time, we got very, very close to the 200 EMA. And here's the second point. After that, the ECB decided to make a rate cut. So the whole French market immediately started to crash. So the German market is down, the French market is down. Let's take a look at how the UK 100, so the British market, reacted. Now, we know exactly that the ECB decision is not the BOE, so the Bank of England decision. And there is a difference because the Bank of England is probably, leaving the rate. Meanwhile, the ECB was cutting. We got the negative pressure because the EU and the UK is still in a strong tie from the economic perspective. So therefore, the market is also reacted to somehow negatively. As you can see, that not as negative as the German or the French market, but it's still pointing to the downside. It looks like the scale EMAs does not let the prices go to the upside. So we're underneath the 50 EMA, getting closer and closer to the zone between 8,010 and 8,047. And so this is a very significant movement, and I think the Bank of England decision can somehow over time, counterbalance the ECB decision, but only until the point the BOE is deciding to cut rates as well. So this is very, very interesting because of the last 2 years I made YouTube videos and pro live streams. But before we get there, let me just show you the EXY, which is the euro. And as you can see, the euro is really struggling technically because of the zone, but at the same time, during the trading days, we have very aggressive negative days, and that's a huge negative pressure on the EXY. The zone is really important because we technically have a very long-term consolidation here, which was signaled by the 200 EMA and then the 50 EMA on the daily chart. As you can see, golden cross after death cross after golden cross after death cross, which is a typical sign of a consolidation for long term. And if we can break this zone to the downside, there is a high chance that the price will not be able to stop, because then every single bank is technically selling euro against other currencies. And if we take a look on the BXY, which is the British pound, so how did they reacting for the rate cut? We also getting a rejection from this zone. There is no breakthrough. We talked about that this zone is very important, and it looks like it's not too strong to the downside just yet because the BOE is somewhat counterbalancing this negative effect coming from the ECB, but still it is negative, and we are sitting on the top of the 50 EMA, which is interesting, but at the same time it's pointing to the downside. So two currency index which suggests that there is a very serious negative sign. Whether we will get the negative movement or not, furthermore, is I'm not saying it's a mystery because we got more chance for that, but we need to see, and that's why we need to follow the levels, whether they break to the downside or not, and whether the fundamental environment is still supporting that kind of direction. But so far, especially in the case of the European Union, the fundamentals are supporting that. So everything is down. The whole European market is down. So what the cause for this downward movement? Well, first of all, the first cause is technically the rate cut. And remember, what did I say so many times? Every single time I emphasize, even on YouTube videos, that once the rate cut occurs, it will be negative for the market, and the European market is immediately reacting negatively. In fact, they are really strongly. I mean, they are crashing to the downside. Look at the DAX. This is a beast. So this is a signal that there is a very, very big trouble on the European market right now, and the only way to stop this is to make sure that energy prices are start going higher, because it depends on what fundamentals behind the rate cut of the ECB. They still can turn around and start raising interest rates. The only thing can stop this fall is the raising of the interest rates, and this is a very controversial situation right now. So the other reason is the rate difference between the European Union and the United States, because the ECB cut the interest rate, so now it's lower. It's been lower, but it's been fixed between the US and the EU. But now that they cut 25 basis points, the rate gap between the EU and the US is getting higher, which is very positive for the DXY, and that's the second main reason why we experienced on the DXY, that the DXY went to the upside right after the rate decision of the Fed. Now, this is a big answer, because if you take those puzzles together, you will understand that we have at this point. Let me just go down to a lower time frame. So at this point, we have a very, very negative macroeconomic data, which is the inflationary data, the CPI, the PPI. It all goes down, but firstly the CPI, of course. And then right at the point, I mean, like, this is like almost for pips, found the zone to the downside, and then turned around and started to aggressively rising and still rising at that point when the Fed made the rate decision. So because the ECB cut the interest rates, the biggest question in the bank environment was that if the Fed is also cutting interest rates, there is no point to buy DXY. So if that didn't happen, the DXY would fall like crazy. But the Fed decided to leave the rates elevated at 5.50%. And this decision created the real confirmed gap between the European rate, the rate level, and the US rate level. And so this is an all-in buy for banks because of the rate difference. I talked about this in January, exactly at my birthday, that how this situation is working out. And I mentioned to you that we need to be prepared. So if you watched the rate decision, you knew exactly how to prepare for that. If you knew exactly how to prepare for that, you're probably rich right now because you knew what's gonna happen. I warned you months ago, and I hope you've been able to use this opportunity, because I did not joke, and you see the result there. So this is why it's very important to choose your own asset, your own market sector, and following and watching the Discord server what we talk about this market sector or particular asset. Because if you don't watch, you're not going to be able to use it. And we used to warn you months ahead of possible happenings. So that was the reason why the DXY started to go to the upside. And because of the rate cut happened, the rate cut means a bad reason. So that means a bad situation in the economy. And if you understand what that means in the European Union, you will be understand why the market is actually reacted negatively immediately. So now let's see a little bit how this could affect the US market. Because right now, what we see is there is no rate decision, no rate cut decision from the Fed. So there is no reason to start sell off on the US equity market or whatever market we are talking about. But at the same time, the DXY is very strong. In fact, the rate gap is so strong, it has so strong effect on the currency that is counterbalancing the negative effect of the macroeconomic data. So you can imagine that the banks got a green light for all in on the DXY. That's a very, very important one. At least they used it until this moment, and now they need to also see how the other macroeconomic data and the US market will react for the following weeks, the following months. So first of all, let me just remind you for a couple of things. Here is a chart. This is called the RSP, which is the S&P 500 Eagle Weight ETF. That means it's, if I want to take into simple words, it takes down the leader stocks from the ETF itself, and we can see the real performance of the ETF. Now, it's not 100% eagle weighted, but it's getting very close to it. So as you can see, when everything started to fall in 2022 January, technically the whole market was very sad, and that was very sad until this moment, until this peak to the upside. We got one more wave to the downside, and then this was the moment when, and this is very important, only a handful of stocks are responsible for 40% of the SPY right now. So this 40% started to, booming again because of this AI stupidity. And technically what happening is right now, the rest of the market is falling. And if you still deny this fact, I'm going to show you a couple of things today. But just remember, the rest of the market is falling. Even less is stagnating right now, and only a handful of stocks are responsible for the market is going to the upside. But if we compare this, because imagine we are very close to the previous high. So look at that. We are actually at the previous high. If you take a look on the SPY right now, that's a completely different picture. Let me just zoom out. That was the previous high. Here is the weighted price. So that much we went further to the upside just because of a handful of stocks. So can you imagine what's going to happen if the market is deciding to go negative when the Fed is deciding to cut rates? Because now you got the proof, because I always told you, and so many people just went against me on YouTube comments and everywhere, that you talk shit because why the market would go down. I even made educational videos about that, why the market would go down. Even 2 years ago, I started to talk about this in a podcast, why the market would go down if the Fed deciding to go start cutting interest rates. And we see the proof right now. We see in the European Union, and we see the signs of the British market as well. So once the rate cut comes, the rate cut doesn't happen for good reason. The rate cut always happening for bad reason. In a bad economic times, of course. And therefore, the market will react in a negative way. And so it started in the European Union, and once it's starting in the US, we will see exactly the same results, and only a handful of stocks responsible for main indexes to go to the upside. There is another example. Here is the NDXE, which is the weighted, eagle-weighted chart of the Nasdaq. And so again, here is the upper part. Here is the highest point we reached, and we are at this point. And so if we take a look on the Nasdaq chart, you will see how higher we are from this zone, the highest point. Again, only a handful of stocks. So this is something we need to pay attention for that. And you need to start investigating the opportunities or the possibilities. What happens if it breaks? What happens if something, not only the rate cut, what happens if those companies are starting to report tighter margins? We don't even need a rate cut. When they start to go down, everything will start to go down. So why would it break? One, because the US market sees how the European market and the UK market is reacting for rate cuts, plus every other reason I mentioned just a couple of minutes ago. Second, the bond market is weak, but we see surge in rush to safety. And as you can see, the yields are going down. They're not too hard at this moment, but still going down. The 2-year yield is down, sitting on the 200 EMA. The 10-year yield is already underneath the 200 EMA. But I told you that the 200 EMA is a zone. In fact, We went all the way down to here from the 200 EMA, because the 200 EMA, you can imagine that every single EMA is like a zone. So we don't know whether we are leaving the 200 EMA or not. So betting that we already broke is a bold thing, because that wasn't true at this point. So be very careful when you base your trade on EMAs or any kind of moving averages. But it's heading lower. Right now it's heading lower. At the same time, the bond market is very aggressive to the upside and breaking the 200 EMA, or it looks like it's about to break the 200 EMA. And so people are rushing to safety. Now, the US Treasury is also playing a games between several types of yields. For example, the 30 and the 10-year bond market, because they try to manipulate this market to pushing a little bit lower the yield so they can push up market prices, whatever is hyped right now in the S&P 500 and the Nasdaq. So those are the reasons why the market, not the market, but this handful of stocks going to the upside. And so now you know exactly what to watch. If they are breaking individually or together, it's going to be the end of the story. And that's the only thing can make a suggestion when it's going to happen. So we don't have a timing. We can't say that, it's going to happen on, 11th of July, 4 p.m. We don't know that. We have no idea. Nobody has no idea because too many factors are there. But we know the factors. So if we're following the factors and the factors show that something is about to break, then this is the end of the story. So 3 things to watch on the market if somebody is interested about how long the SPY and the Nasdaq can go to the upside. 1, the rate cut in the US. If it happens, it's going to crash. But that's a very thin ice because Jeremy Powell is really afraid to cut interest rates right before an election and, fuck the whole market. This would be disastrous. And Jeremy Powell would, probably having an accident or something like that. Second, we need to see the manipulation between yields. If this manipulation showing a different direction, then it's over. They're not pushing the yields down anymore. Yields could go to the upside, which will be inflationary anyway, or at least it's mirroring the inflation. But then the market will crash because there is no more reason to holding those stocks. And yeah, as I said, it is a very, very, very sensitive game because once those handful stocks, they are tech stocks related to AI, they're starting to report less margin, then the market will react. Definitely, there will be a complete sell-off. And therefore, we need to watch the earnings, the Q2 earnings as well. We don't know whether they're going to start reporting, declining margin or not. We need to see the results. I'm not predicting this one. I already predicted that this time is coming. I just don't have the timing when it's coming. But we already saw very bad results, and we already see the negative effect on the market. In fact, people say you can't short in 2024. I mean, really? I mean, you're really talking to me that you cannot short in 2024? Now, I just brought just a couple of stocks to show you that in fact, if you're really an experienced trader, maybe in some occasion you go against the trend and you're shorting because you really that experience, or at least you think about yourself the experience. You had the reason to shorting, and I'm not talking about small companies. Not talking about small companies at all. So let's just see IBM. What IBM did in 2024? Well, it crashed 18%. 18% crash in 2024. IBM, one of the largest company on the world. Okay, let's go forward. AMD. What AMD did in 2024? Look at that. Crash. 37.9% crash on AMD. It's fundamentally a bear trend. You can't short, right? The market is going to the upside, right? Okay, let's go forward. What else we have? I have a couple of them to you. Here is Intel. Intel Corporation, one of the biggest company on the world, what it did in 2024, because we can't short in 2024, right? You cannot short, right? 42.1% crash in 2024. You can't short, really? The market is going up? I said a handful of companies, but I'm going forward. Like, let's see a different industry. Nike. What Nike did in 2024, Nike went down 28%. This is a market crash, okay? It's happening. It's happening right now. It's happening at the front of your eyes. And for the S&P 500 and the Nasdaq going to the upside, only a handful stocks. These handful stocks, they are responsible for 40% of the market in the S&P 500. 40%. Can you imagine? The rest of them is going down. I show you, it's going down. I'm going forward. CAT. What did CAT do in 2024? Only went to the upside for a little bit, and then it already crashed 17.3%. It's called a market crash, okay? Don't make mistake. That's called a market crash. I'm going forward. What did Tesla do in 2024? Because you can't short the market, right? Tesla is in a bear trend. Look at that bear trend. This is a bear trend. And so let's see what it did in 2024. That's 2024 January. It crashed 47.7%. It did happen at the front of your very eyes. The market crash is happening right now. It's just not happening together because of some of the hypes. Open your eyes. What did Volkswagen do in 2024? It's already crashing forward. 19% crash. Okay, I'm telling you only big companies. The biggest companies in the world, they are crashing like hell. What did Boeing do in 2024? Because you can't short the market, right? I'm stupid to talking about bearish market, right? I'm very stupid guy. It's already crashed 9%. 9% today. But if we go out and see at the beginning of 2024, look at that. Look at that market crash. 40% down. Is this the market? When I said that the market will crash, really the market does not crashing? It is crashing. The biggest companies in the world are crashing. And the rest of them will go down with them when the 3 reasons I just mentioned is going to happen on the market. So let's go back a little bit and see the explanations of my points, because my points going to tell you what is the current state of the market. And this will be one of the best predicting data, which is going to tell you how when the market is preparing to crash. Now, when the market is preparing to crash, it doesn't mean crash just yet. We need the reaction for that. But at least we're going to get the sign, the signal that it's preparing. Let's start with the stock market, okay? The overall point in the stock market is declining from minus 38 to minus 44. Why, Thomas, the S&P 500 is going to the upside, right? And the Nasdaq as well, you're talking rubbish, right? I just showed you the largest company, and I just showed you the largest companies. I didn't even show you the small companies. They are crashing too. Everything is crashing, unless a couple of handful stocks. That's what I told you on the Discord server yesterday. Unless a handful stocks, they're going up with no reason, only because of the hype. And Safe Haven. Safe Haven is going up, but Safe Haven is supposed to be going up. Don't mix that together. So, yes, the market is pointing down very aggressively. And when I told you on the comments that the stock market is divided for a long time because of the AI hype, Only a handful of AI companies can stay in bull trend. And the non-cyclical essentials, they are the ones they really staying in a bull trend. But we started to lose more and more AI companies. I just showed you IBM, AMD, anything that has a relation with AI companies. And people misunderstand the strength of the essentials. So the decline in overall points suggests that more and more share price will turn into red, while the hyped stocks will continue to pull up until a rug pull happens. I just told you what the three reasons for the rug pull. I don't have set date for this to happen, but we know that we get closer for this every day. Therefore, be very careful on the stock market. If you don't know this sector very well, you can burn yourself very quickly. So intraday traders are in the best situation right now because if they go to the upside, for example, with Nvidia or any other hyped stocks that currently rising, they're gonna open, close, cannot stock in a position when it starts to fall. And it can start to fall anytime when the shit hits the fan. But they also good to the downside because we are not shorting long term. You can do that, but you have to be very experienced in fundamental analysis. Because if you don't, you're gonna be the same guy. Like 2 years ago, I had one guy in the Discord server. He's already gone because he didn't listen to the analysis. He just, listened the first word, short. And he started to short Nasdaq on a daily time frame, completely ignoring all the support, completely ignoring all the fundamentals, completely ignoring everything. And he sucked. And then he sucked, he lost his money, and the market finally started to fall. I mean, you need to pay attention. You need to pay attention and you need to start learning. So the stock market is pointing to the downside. If you have a look, long-term drivers like macroeconomics, geopolitics, corporate earnings, they are all heavily down in very negative territory. They are the long-term drivers. Short-term drivers are accelerating to the downside. Market news from -1 to -3. Market sentiment is reacting for that from -3 to -5. And the technical is the only one just keeping, I wouldn't say up because it's -1, but turning back down from +1 point. So why the news are going down? Excuse me. Why the news are going down? If we take a look on the ETF and the stock market, what the market is focusing on, the narratives are focusing on, is that they try to emphasize that the market is overbought, especially the AI market. And there is more and more Trump-hating narratives are coming up right before the election. So that's kind of negative for the market, or at least we see some negative reaction. We see negative reaction. You can't say we don't because the point is dropping from -1 to 3. And the sentiment and the reaction is dropping from -3 to -5. So yes, this is how the market choose to react for these narratives. And the market is preparing right now. So you got to be ready because any of the 3 things I mentioned is breaking, it's gone, the game over, that's it. Even the handful of stocks will start to fall and they just drag everybody down with themselves. Even Boeing with the 40% drop, it will drop even more. And that's just 2024. So the market is crashing at the front of your eyes and you don't realize because you are just living in a pink cloud. I'm talking to the people who live in the pink cloud, that you're living in a pink cloud of the S&P 500 and the tech 10 stocks that it's actually creating the bull trend. Because of the size of the money, your money, in the companies like Nvidia, that's your money. And I'm telling you, you will fail to get out at the top. And whoever doesn't fail to get out at the top, they already cashed out. You already lost your money, you just didn't realize. That's a very important point of the US stock market right now. And you know this is going to happen because you can see the living proof with the European market in the moment of the rate cut, even just 25 basis points, the market started to crash. It created a rate gap, which has been confirmed by the Fed. It will be stable, at least until the next rate decision. And this is extremely bullish for the DXY. What do you think? How the market will react next to an extremely bullish DXY? Be very careful on the stock market, okay? Second, ETF market. Overall point is declining from minus 26 to minus 35. What I said, S&P 500 and Nasdaq still have higher points. The overall point, we need to take them separately because it's a stupid market. So there is an overall point for the S&P 500 and the Nasdaq, and the overall point of the rest of the market. I'm going to show you that later on. And so what happens is that the S&P 500 and the Nasdaq still have higher points, but the Dow seems to be losing the game along with Russell. So the overall market is negative, including all market sectors on the ETF and the index market. And since we started to lose big indexes as well, the overall points has to drop significantly. So no improvement on the three long-term drivers. As you can see, the macroeconomics, the geopolitics, and the corporate earnings, they are all negative. So no improvement whatsoever. And the short-term drivers are also turning into negative. Market news and events from positive 1 points to minus 2. Market sentiment and psychology from minus 2 to minus 4. Technicals from positive 1 to minus 2. No doubt that the whole market is going down, except the ones with the handful of those stocks. Be extremely careful when you state that the stock market is going up. The whole stock market is crashing. I just showed you the percentage. The biggest companies, smallest companies, wherever you go and check the chart, what did they do in 2024? The stock market is crashing. It's happening right now. You need to be aware of that. Commodity market, on the other hand, the overall point is declining from 47, that's positive, to 41. It's still positive, but it's declining. So what does that mean? The two long-term drivers, the macroeconomics and the geopolitics, they are relatively stable. As you can see, the point is not declining. I mean, the long-term trend is declining, but it's still, stably positive, at least since the beginning of March. Excuse me, I'm ill a little bit. Geopolitics, they are pretty much stable. As you can see, they're very stable. They are positive for the market. However, each short-term drivers, such as market events and news, market sentiment and technicals, declines a little. And this is the reason for the relative large overall point drop from 47 to 41. While the commodity market remains divided, I do not experience huge threat, but the overall market point decline suggests some cooling on the market sector. While the global economy did not improve, I expect range movement in the next few weeks, except assets that are under trading hype right now in the commodity market. Starting with slight positive movements probably at this week, at the beginning of this weekend probably, or maybe at the beginning of next week as well. That's the commodity market. So as the Forex market though, we're gonna talk about that Forex market a little bit longer in the second part of this live stream. So as you can see, the overall point of the Forex market is increasing. So from minus 21 to minus 19. Now, just to make it sure, so the macroeconomics is the responsible for that, because the macro says that the DXY has a negative effect. So therefore, counterbalancing the market and the rest of the market, like EXY, BXY, JXY, AXY, ZXY, etc., they're going to the upside, or at least they get positive effects. Geopolitics is relatively negative, somewhat counterbalancing the macroeconomic positive effect, but both of them in negative territory. Market news are going to the upside because because of the election, they need to report declining inflation. What declining inflation means to the market? Negative for the DXY. But the market psychology is going down because of the rate decision. Because we're talking about the bank's sentiment and psychology, not the guys sitting at the front of the computer at home and trading. No, we're not talking about that. Pepperstone is very happy with them. I am very happy with them. But we're talking about banks now. How banks thinking. And when banks smells money, they're going to go there all in. And they did. They went against the macroeconomics. They went against the market news. They went against everything. And this is how much power they have. So, while the overall point increases slightly due to strong macroeconomic effects, I must highlight that the sentiment and technical picture of the DXY goes against the effect of the macroeconomic environment. The overall point increase suggests some positive move on all indexes except the DXY. But the new ECB rate cut decision created a large gap between the US and the EU rate. This rate gap is generally positive for the DXY, which means that improving sentiment and technical point can and will counterbalance the macroeconomic effect over time. Therefore, I will focusing strongly on this anomaly. Meanwhile, I urge you to watch on the sentiment and technical drivers point so we can spot when the anomaly is the strangest or the strongest. Well, it's strange and strong together, week by week. I hope you got those puzzles together. Because this is a perfect description of how to trade on the Forex market right now. But I'm going to show you in the second part anyway. That was the Forex market, sorry. How is the crypto market right now reacting for that? Well, the overall point is going down from positive 8 to positive 6. I mean, some decline. There is a cool off, as you can see, since November, actually. So the market is cooling off since November, and there is no improvement. We don't break this trend, this cooling trend in the overall point. And so what I said that the overall point is declining slightly since our last live stream as well, from 8 point to 6 point. But it is interesting to see that the point itself is stable between 3 point and 8 points. I mean, this time period, we are stably between these points. So this does not suggest any big trouble yet, at least. So I consider this as a generally slow market that has not decided to go down, at least not yet. And this is still positive for the bulls. News are increasing in points. I would like to highlight this. As you can see, it's going up from 2 to positive 4. And here's the important part, that this is always the first sign of volume. Therefore, in the next few weeks, I hope that we will see some trader reaction in the sentiment and the technical points, which at this time is expected to be positive. So the three main drivers to watch is the news, sentiment, and technicals. But mainly that we need to make sure that the news point is staying relatively in increase. Meanwhile, we need to start seeing some positive sign in the sentiment and psychology point and also the technicals. If we see this, we're going to get a bull market continuation and probably a breakout to the upside, at least on the total market cap or Bitcoin. So that's really important. So this is the fundamental behind the market right now. And I told you way too much already. So you should be able to figure it out where to trade and how to trade. But for pro members, we're going to do another part of this market analysis. And this will be the chart. So